Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to the Finance Garage. As always, Jonathan Wu here, Senior Financial Advisor and Principal here at the SWU Group. So today we have another guest from Ausbill, who is a stalwart in the Australian equity space, and obviously they also have a global business, which we featured Tobias Bucks last year on the first podcast about global small caps. Now today we have Gian Pandit, who's the Deputy Head of Equities at Ausbill. I guess Gian himself is a stalwart. I think the worst way to sum it up is you used to run money for the Packers.
Yes, and I'm very, very old.
And you and so I've known Gian probably 10 years. We, back to you when you first came to Ausbill with your strategies, and you're probably one of the people, as you sort of premised just before we started with the record button, is you don't get excited easily. And you're not a bond manager not excited, where, you want to slit your throat sort of type scenario. But I guess the nature of the way that you invest, which is long short or market neutral, you have a tendency to, like at the moment in the strategy that we're in, you're net short.
Yes.
So I guess the preface for today's podcast is to sort of go through reporting season, which you've just had in February, which is probably quite an interesting one compared to what we've seen in a number of years. I mean, what's your overall first impressions?
Look, I think, and thank you very much for having me on today, and for your support for the last 10 years, Jonathan. But as you know, I've been running money since 1995, and I would say this reporting season was the most volatile reporting season I've seen for quite some time. It was a mixed reporting season, but it was incredibly volatile. And when we unpack that, we've seen the market in February fall 3.5% in the ASX 200, and that was driven by all companies' EPS numbers falling by 2% in the reporting season, because we had softer free cash flow numbers than we envisaged, and we saw top-line revenue disappointing in most companies as well. And what really exacerbated the sell-off has been the volatility in the global macro situation too. So it's thrown up a few opportunities, but it was an incredibly volatile reporting season. The second point I'd like to make on it is that it's the first time for a long time that we saw a material factor change. What I mean by that is that for the last 2 or 3 years, we've seen momentum has been the lead positive factor in reporting seasons. And for February, it was actually the worst factor, where dividend income was the best factor driving the stock market. And that was reflective of how PEs actually contracted over February.
Given the fact of how volatile and I guess violent the moves were, and we've spoken to a number of managers and they all sort of share your same sentiment with regards to this, did it surprise you?
No, it didn't, because when I look back, and you're right to say I don't get excited too often, but as a long short manager and running long short for over 25 years, it's important to have a glass half empty view and make sure that the companies that you invest long are the ones that you can be there for the long term. And also you want to invest in those short companies that are structurally short. But it didn't surprise me, because if I look back and over the last 2 years, all companies' EPS growth in Australia has been close to zero. But in the last 2 years, the market's up 20%. So we've seen great price momentum. We've seen great PE expansion in Australia in the last 2 years. So at some stage, we were going to see some sort of contraction there and some sort of pullback, because at the end of the day, we truly believe on earnings and earnings revisions driving share prices. But at some stage in this cycle, we've seen PEs just expand too much.
With that drop, and it was one of the worst post reporting season, do you think, even though it didn't surprise you, was it justified?
I think it was justified because with the market dropped, the ASX 200, if we just look at the numbers, that dropped 3.5%, and all companies' EPS numbers dropped close to 2%. So we had an extra 1% drop there. But then when you look, and we don't invest in a vacuum, and when you look at the global macro situation with Trump and Besant's policies coming through, that certainly added the volatility to see a further drop. But it's also from the bottom up perspective, we did see quite a few companies miss on its earnings, and we saw violent reactions on those companies, which also exacerbated the move down.
Which sectors broadly did well this time around?
Well, it's interesting when you look at it, and as I said, preface the conversation, dividend yield was one of the better factors. So certainly the utility sector outperformed. APA primarily in that space, which reconfirmed a very strong dividend and gave good forward guidance. But what sectors really outperformed had the same type of characteristics. They either gave you earnings upgrades, or they gave you a strong revenue number, or they gave you strong free cash flow. Certainly, the commercial services space and media had those three attributes. Light and Wonder gave you a good top line beat and good forward guidance, and News Corp similar as well, which drove that sector outperformance. And there's certain industrial companies as well that led to outperformance, but particularly CPU and A2 Milk. But again, those attributes of top-line revenue strength or strong and earnings or earnings revisions.
Okay. Who were the naughties this reporting season?
Well, it was interesting. I mean, we've been discussing banks for the last 17 months, and I would say banks were a highlight of a negative sector. And again, when I look at overall on the companies that missed, and they missed on three lines. They either missed on margin, which collapsed. They either missed on free cash flow, which disappeared, or they missed because their forward guidance was ratcheted down. And when I look at banks, Bendigo Bank was the first one that came out which gave you negative jaws. They haven't done that for 7 years. So you're seeing costs going up and the revenue going down, and that bank got hit. Then on the quarterlies that came through in NAB and Westpac, we saw a slight contraction for the first time in net interest margin. And
First time since when?
First time for about 4 years, 3 years, I should say. We've seen a contraction in NIM, and we're seeing a slight uptick, not albeit from a very low base, in BDDs or bad and doubtful debts. And we saw National Australia Bank fall over 15% in 2 days. So a material sell-off, again, because the multiple was too high, and if you miss and you're on a higher multiple, then you're going to get hit. And certainly the bank sector. The other sector I think that did poorly, which surprised me, was healthcare. Cochlear had a small miss of 5 to 6%, and the stock fell over 12%. ResMed had a good result, but the multiple was perceived to be too high and also sold off. Polynovo missed on both bottom line and top line and got hurt. And CSL, which has been a perennial favourite of mine since 1993, had an inline result, but has been used as a funding source and also sold off. So certainly healthcare was also quite a weak sector. Then when I look at the tech sector, one company that came out was WiseTech. They deferred their quarterly product launch, and the stock was actually hit very aggressively on the back of that. But I think there was more towards that tech sector where we just saw a material P/D rate in that sector, and that was quite violent, and some of it was quite unjustified. That we saw that type of volatility come through in that sector.
Because I was talking to another manager, now they've focused more on Aussie small caps, and they've basically said since reporting season, any stock that fell by 20% because of some violent movement hasn't recovered, right? Since for over a month now.
Yeah.
They're all treading water still.
Yes. Well, in the large cap, that's quite correct, but there are a few exceptions. And the exceptions to the rule are the companies that actually delivered good earnings, but were taken down because of the macro top-down view. And what I'll give you the example of Life 360 that delivered. It was one of the better companies that delivered. Again, beat on top line, gave you a good outlook statement, and delivered on EPS. But the company is actually down 20% since the delivery of a very strong earnings report. And that's been taken down, in my view, in regards to this whole PE compression that's occurred, which has been driven by the macro top-down situation, what's happening in the US. The NASDAQ clearly has moved down 6-7%, and that's taken down part of our tech sector. So that's the type of volatility that gives us the opportunity to sift through these companies and see the ones that we really like, that we believe that either have strong earnings upgrades coming forward, or on less than a peg of one, that we can see strong growth coming forward for the next 2 to 3 years.
Using those sort of metrics, I mean, the CBA is still the talk of the town in the sense of, it's up 70% in 12 months, very little earnings growth.
It's up more than NVIDIA in the last 12 months.
And it's trading, I think, double JP Morgan's valuation.
Right? More.
More, even more. Yeah. One, there's CBA. Yes, there's the rest of the banking sector. Are we poised for a potential large correction in the banking sector?
I think
it's
so.
Artificially being held up.
I think so. I mean, the banks are our largest short in the long short focus, and we're about 300 basis points net short CBA. Through the long-term cycle, I've actually been long CBA for 20 years of my investment career. And it's really been in the last 3 years that we've been building the short on CBA. And very simply, when I look at CBA, it got up to 3.6 book, which is the most expensive it's ever got to, and it's the most expensive retail bank in the world. Now, that's all okay if that's been driven by strong earnings and earnings upgrades over the last 3 years, but it hasn't. And earnings have really only ratcheted up pretty much 5 to 7%, and the stock, as you mentioned, is up close to 70% over that time frame. So then you strip it back and say, well, we've certainly seen industry funds buying CBA, buying the banks over the last 2 years as they're getting set to be more neutral to the Australian landscape. We've seen passive money flow that's come into this country, and one way to capture it is buying CBA. But as a fundamental investor and an investor that's very much driven by earnings and earnings revisions on a bottom-up mentality, it stands out to us as a very good short for the next 12 months. What really interests me now is that in the rate hike cycle that we went through, we did see net interest margin expand in CBA, which consequently led to part of the rally. But the Bendigo result has given you the indication that NIM is starting to contract. NAB and Westpac on their quarterly numbers has given you the indication that NIM is starting to contract, and the BDD, the bad and doubtful debt cycle, is albeit coming off a low base, is slightly turned here. So I will be very cautious a bank like CBA that's exposed to those attributes as well, and they're certainly not priced for the earnings that they exhibit.
Let's talk about sort of investment style and how you see the impact of that sort of going forward, because when you invest in equities, you can be a value manager, you can be GARB, you can be growth, you can be agnostic. And you sort of made a comment earlier that you said we shouldn't be wedded to a particular investment style because of the way markets are now. Can you sort of elaborate on how that works for you?
Well, I think the Australian market is very narrow, and I think when you look at true value stocks, there's only a handful of true value stocks, and the majority of them have a lot of hairs on them. Then when you look at true growth stocks, again, there's a bigger subset of those, but they've gone so far in terms of valuation, it's very hard to actually invest in those names at this level. So I think you need a process that can actually traverse both styles and actually look at all companies in regards to putting a portfolio together, because we're very focused on earnings and earnings revisions driving share prices, and you can get earnings and earnings revisions in value and growth names. And we hopefully rotate at the right time of the cycle to invest in those companies, because it's about putting good stocks in combination, not in isolation, to drive two outcomes: to drive alpha generation, but also to give you some sort of semblance of capital preservation when we do have a drawdown, and heaven forbid that we do, because the market has become very complacent in regards to the markets rallying. The Nasdaq has rallied 25 and 25% in the last 2 years. As I said, we're up over 20% in 2 years with zero earnings growth, and we haven't gone through that period of any substantive correction. So that capital preservation mentality, which we actually enforce into our funds, is not looked at the moment. And I think it's a discipline that's needed, and to deploy that discipline correctly, you have to have a look at all opportunities in the marketplace, not just value companies and not just growth companies.
Do you think that what we're seeing now in terms of this, you call rotation, correction, whatever it is, given the fact we haven't seen a material one for so many years, is it one, do you think it's just healthy and investors should have that mentality to go, this has to happen once in a couple of years, just trying to keep betting on black just because the last 3 years were black, and then thinking that the fourth year will be black is just simply becomes a mugs game? And do you think that, have we seen the last of this part of the correction cycle, in your opinion?
Look, I think all corrections are healthy, and I think all corrections are driven by bottom-up features in terms of earnings and free cash flow. I think this correction, and it's quite extraordinary that we're talking about a correction, because really by the end of yesterday, our market was only down 1.5% as the accumulation index, and everyone is panicking on a correction, and we're down 1.5%. So I think what's really occurred is the volatility in the global macro is somewhat a concern, and I think that you want to see corrections, particularly in names that you want to invest. And we've had this conversation. I'd love to be overweight CBA at some stage, but I can't see it until it comes down to a compelling valuation. I'd like to be overweight Pro Medicus at some stage, but at the moment it's on 200 PE. So I think corrections are natural, and I think they're important. But what's also important is to be patient through this period and make sure you've got those companies that have that earnings support and have the possibility of earnings upgrades at the right multiple.
So, Gian, you talked about the macro backdrop and the macro tensions, right? And I think everyone's really focused on tariffs, right? I like to call him Agent Orange. And he has basically come out swinging with tariffs, China, Europe. And the thing that I always say to investors is, everyone likes to talk about the US-China trade war. The reality is the US-China trade war has been going for 8 years. China knows how to deal with it. Europe has no idea because it's never been in one. Australia has no idea because it's never been in one with the United States. Now, you have a sort of a short and a long-term thesis around this and why he's doing it. One of them, for myself, is that at the end of the day, one of the biggest things with Elon, for example, is this Department of Government Efficiency and cutting budget deficits. And a big part of that deficit is, effectively triggered by what? The interest bill on their debt, which keeps growing, 36 trillion US dollars or whatever it is now. And if there's an ability for him to try to slow growth or kill growth through trade tensions or whatever to force the Fed's hand, who's technically independent, to cut rates, he can refinance that debt at a lower interest rate and reduce the deficit. And that's one part of it, and I know that you partially agree with it.
So I think Trump's tariffs policies are the tip of the spear. So initially, when everyone thought they was going to put tariffs on, it was the fact to put it on so he gets people at the bargaining table and then they'll come off. I have a bit of a different view than that. I think 20-25% tariffs on China will stay on for the medium term. But I think to really see what his policies are and how they're going to be enacted, you have to pay attention to Scott Bessent, which is basically the Secretary of the Treasury that he's employed. Now, before he got into power, Scott Bessent was very negative on Janet Yellen. He believed that she should be rolling the debt to a 10-year view and not over a 30 or 90-day view. He also was very negative of the previous government because he believed that they overstimulated on a fiscal measure. In fact, we had over $3 trillion of fiscal stimulus under the Democratic government. So he's stood up now, and what has Scott Bessent done? So he's basically put a pause to fiscal stimulus, which has had the effect of bringing the US 10-year down from 4.6 to 4.1. He's also then turned around with the view of he wants domestic infrastructure built. He wants a domestic economy manufacturing base. So he needs the US dollar lower. So by pausing the fiscal spend, has also started to bring growth down gently, and the US dollar has also come down. And I think these policies are adding to the volatility in the short term. But his real priority is to roll the debt. So he's got in May he's got $4 trillion worth of debt to roll, and he's paying $1 trillion of interest on that debt. So if he can get that US 10-year down close to 4 or with a 3 handle, then the cost of his roll and the cost of debt and his refinancing is going to be much lower. So this is adding to the volatility in the bond market. It's adding to the volatility in the equity market because the Fed's now come out and lowered their guidance on GDP growth to 1.7 to 1.9. Last year, everyone was anticipating US GDP growth and US exceptionalism to drive growth to 2 to 2.5. So the Fed's come down and indicated with the tariff policies, with this domestic onshoring and growing manufacturing, and with the advent of a debt roll, we're going to lower our growth assumption. And they've also come out and indicated that inflation is going to remain sticky, which is above their target range, which gives you the nuance of stagflation in the short term.
Correct.
Now, that's all in the short term. I think you need to take a step back from that and then look at the long term. What Scott Bessent has said while he's been in power and works for President Trump is that he stands on 3 pillars of policy. First pillar is for US GDP growth to be 3%. The Fed's now indicated 1.7 to 1.9. The second pillar of policy is he wants 3% for the government deficit to GDP. And he can actually deliver that if he can get the debt profile lower. And the third policy is that he wants 3 million barrels of oil supply or oil equivalents to come into the US, which will lower his inflation targets as well. Now, these in the long term are very, very pro-growth, pro-US. And if he can achieve that, you're going to see the US start to re-accelerate again over a multi-year period. But everyone is focusing on the short term, and I truly understand what's happening in the short term. And there's a lot of volatility in the short term, and the US consumer has been affected by it. And so we could see a further sell-off in the marketplace in the short term because we don't know how all these policies will play out. But in the long term, his goals are on those 3 pillars. And if he can drive to those 3 pillars, then we're going to see long-term growth in the US.
What does that mean for you short term in Australian equities?
In Australian equities in short term, you have to be very focused on 3 things. You have to be very focused in earnings and earnings revisions being positive in the companies that you're long. The second thing you need to be focused on is that are they at the right multiple at this stage? Because the volatility, as you've seen in the reporting season, has taken PE compression down. And the third thing you want is strong balance sheets at this time. So quality as a factor is what you want to be long in your portfolio at this stage. And that's probably pretty much for the next 3 to 6 months. Because I really believe this year is not going to be like the last 2 years that momentum just drives share prices. I think what's going to really drive share prices is quality and structural growth where you're seeing strong earnings upgrades coming through. Momentum won't just do it.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
If you believe that Trump's tariffs are not a bluff and he's going to stick by them, and in the Australian context, we've seen aluminium and steel get impacted. The reality is that aluminium and steel put together is 60 basis points of total exports, as in
Yeah,
aluminium steel to the United States is
sure.
60 basis points of export. Do you see any other potential targets Trump may use and therefore impact your valuations on those particular sectors?
Well, I think the main usage of tariffs are basically is a tax to the economy to raise funds. So I think there's with an Australian perspective, it's really looking at whether he puts on a 25% copper tax, which could impact our copper companies. But what's more important is the sustainability of these tariffs, because I think the agenda is to use the funds in the tariffs for tax cuts. And he also has the ability and the stick that if the market actually, if we do see growth go below what the Fed is indicating a 1.7, and if the US, and if we do, and it's not our house view, but if we move towards a stagflationary environment in the short term, well, then with inflation coming down, because debt profile is coming down, because growth is coming down, well, then the Fed can easily cut rates. So I think the long-term agenda for Trump is to use tariffs as a tax break and with the ability to actually then force the Fed's hand to start to look to cut rates. And if he chimes that up with the view of long-term sustainable growth coming through on the percent's three-pillar policy, then you're setting up to be a very, very strong environment. So coming back to Australia, you want to actually be positioned in structural growth companies at the right multiple with earning support. You want to be in defensive growth companies that are independent to higher rates or stickier inflation, which are not attached to any tariff policy. And that's where we're pre-positioned at this stage, because the tariffs are just inducing huge volatility in at this stage. And I'm looking at what has just come out last night in terms of 25% tax on autos. And when you strip it back, well, most European countries have a 10% tariff on US cars being imported into Europe, and the US at the moment have a 6% tariff for European cars being imported. So the debate is out whether this is tit for tat. The debate's out whether this is bringing Europe to the table. But where the debate is not out is that he needs to pay for his tax cuts, and tariffs are one way that he can actually pay for part of his tax cuts.
Does anything in that, if your theory plays out and we're going to go back to US having and exhibiting strong levels of growth, do you think that bodes well as a pure, let's call it, correlated tailwind for Aussie equities long term?
Absolutely, it does. So I think long term you need to be pre-positioned. And as we said at the start of the conversation, I'm getting a bit excited with the view of some of these companies that I've owned for over 2 decades are actually coming back to good levels where I'd like to buy them. I mean, CSL is a great example. In 1993, when CSL came out of CSIRO, I invested. That was my first company I invested in 1995 under $8. It went to $300. It's now come back to $250. It's on 24 times PE with 11% EPS growth. So it's still over a peg of 2. So if that comes back down to a peg of 1.5 or 2, that really excites me. And there's a handful of these companies, be it CSL, be it Cochlear, Life 360, GDG, and XYZ that are coming back, that are coming back to the right valuations, and will also have strong earnings. So there is great opportunity in this volatility to see what price points they get to. But patience is what you need.
What do you, did you take anything out of this week's budget? And was there anything material in your mind that would impact your portfolio position?
The only thing I took out of this budget was the ineptitude of the government. So we've got an NDIS bill that's going up north of $60 billion. I mean, it's incredulous. And to tell that taxpayers that you're going to get a 70-cent cut in your electricity bill over a certain period of time is irrelevant. And I think this government is lost the voice of the people. The majority of those leaders have never actually worked in private enterprise. The majority of those leaders have had everything for free since they've been at university, and leaving university, these are career politicians that are not listening to people. Because I'm a son of an immigrant that came to this country in 1974, and I'm a proud Australian, and I think we need governments that actually work for the Australian people. And the cost of living in this country is exorbitant. In fact, I've never seen it as high in terms of education, in terms of rent, in terms of housing, in terms of healthcare. It's just phenomenal. And now you're seeing the cost of living getting exacerbated through food inflation as well. So it's very expensive to live in Sydney. And I think the ineptitude of this government has actually exacerbated that problem. And I think they need to start listening to the constituents and to see what's really relevant in regards and building up bureaucracy for bureaucracy's sake. Is a complete irrelevance. NDIS, there is a place for it, but it's also being rorted to a large extent, and that needs to be looked at. And I think it's very important that governments work for the people. And when you look back, and whether you're Labor or Liberal, you've seen a Labor government with Hawke and Keating that were more Liberal than Labor when they went through deregulation, the White Paper, the Accord, the floating of the dollar. They're all very Liberal policies, and they delivered over 15 years of sustainable growth. Then you look at the Howard years, and he continued that level of growth. And I think, unfortunately, the government has lost step with the reality of the common person.
Because if you also consider one of the things that came out of the budget is that they're proposing even more tax cuts, right? Reducing the lowest marginal tax rate to ultimately 14%.
Yeah.
They've got to pay for that. If the public sector is still really expensive, NDIS is really expensive, how is that even sustainable?
It's not. So it's a supercilious tax cut. Because it just gets passed on to the constituents. So the constituents will end up paying more in other various taxes that come through. So they really have a problem in regards to their full tax policy here. And are we going to see a change? Well, I don't think so. You have to work around that. But honestly, with immigration in this country that's soared under a Labor government, where you've effectively had the size of South Australia coming into Melbourne, Queensland, and Sydney in that period. And that's and we're all for immigration, but we're there for. But you also then need to have the infrastructure to support immigration. You need the roads, you need the hospitals, you need the towns, you need the housing. And we are, and the banks are calling this out, and that we are at a housing crisis in this country. And you've got property developers. And when I touched upon the BDD uptick in some of these banks, well, that's been the tip of the spear of that has been property developers going to the wall. Yes. Because fixed cost properties are hard to do when you got your cogs going through the roof. So you've had a lot of property developers going bust and belly up, despite the fact that we're in a housing shortage and we need houses being built. And that's the irony. So I think the government needs to look at the immigration situation and make sure that they have infrastructure and housing. They also have to be not tied to the Greens, who are more red than green, and they have to go back to, if it's a Labor government, they have to go back to their core Labor policies, which aren't the Green policies. And if it's a Liberal government coming in, then they have to be more pro-business, which they need to enunciate as well. So I think we're at a very low ebb in regards to political leaders, and I think Bob Hawke will be rolling in his grave, and I think Bob Howard is just aghast at what's
He's
happening.
Having a conniption at the moment.
Yeah. So I think it's not so much whether you're Labor or Liberal, but stand up for the policies of your constituents and the policies of your process. And Labor's not doing that because they've got to deal with the Greens.
Finally, let's talk about something that you and I always talk about when we catch up, is the Australian consumer and the state of the Australian consumer. We've talked on numerous occasions around the fact that in every cycle, the consumer is clearly overspending, especially in that post-COVID era. And I remember you made reference to a number of companies that you had shorted, and the resilience of the Australian consumer, even going into the latest rate hike cycle of 13 straight rate hikes, didn't seem to phase. How do you see the consumer or the state of the consumer now?
I think the consumer, when you look at the reporting season and you reflect back on the reporting season, there are a plethora of small and mid-cap stocks in the retail space that completely and utterly missed and got destroyed. Satire, Kogan, then even Super Cheap Auto got destroyed. IDP Education and GYG were taken down as well. So it was actually, as a sector, it was fairly weak. The standout has been JB Hi-Fi. When I look back, the mistake I made is that I should have been long JB Hi-Fi in the portfolio, because that's been trading as an industrial stock as opposed to a leveraged consumer stock, which it's not, and it's been the best consumer stock in the space. I think at the multiples that they're on now in JB Hi-Fi is extreme. So I think it's not only tech companies that are getting taken down because of multiples. We're seeing it with banks, and we'll also see with other cyclical companies that are too expensive. If you're trading on 25 times with 5% EPS growth, you're too extreme. So, but I think the Aussie consumer is still intact, and they are still in a good space because they're fully employed. We haven't seen an uptick in unemployment. We haven't seen material layoffs, and we haven't gone through any recessionary period. So the consumer is hanging on for dear life, albeit under a lot of pressure through the cost of living pressure that's going through. I mean, have a look at your electricity bill. My wife showed me my electricity bill last year, and I had conniptions. And it's electricity, it's gas, it's your healthcare. I mean, we're long Suncorp, we're long Medibank Private. That's the sort of hedge to my private position of paying these guys.
Yes.
Bills that are going going through the roof. And we were long IAG. I mean, I got the IAG bill for my car insurance. I have a 20-year-old daughter who's I bought her a small little second-hand Corolla for $18,000. It's costing me $4,500 to insure it. So go and buy your IAG shares, because the rate hardening cycle's alive and well, and they could probably upgrade because of purely on my expense of my car bill.
Yes.
But look, in all honesty, I think the consumer is struggling. The consumer's under pressure, but they haven't cracked. And this reporting season showed you that some of the ancillary consumer stocks have cracked, but the more inelastic ones like JB Hi-Fi and Wesfarmers hasn't actually cracked. So if you've had a poor balance sheet like Kogan or Satire, you're cracking. If you're a one domicile character like a Super Cheap, you're coming under pressure. If you're Harvey Norman, which is trading now close to 15 times with 8% EPS growth, where normally trades 12 times, if the consumer does roll, then you're going to be in trouble. But the consumer has proven to be a lot more resilient than I thought, and I certainly got that wrong for the last 14 months.
Do you think that now that rates are starting to come down, that given the consumer has been resilient, on an overall basis, you wouldn't foresee it to literally crack and take down consumer staples with them?
Yeah, no, I agree with that. I think what I'm looking for now is that the only way I think the consumer really cracks is that if we have a full blown out recession and an unemployment cycle. And that's not our base case.
Yeah.
And I can't see that happening. So what are the lead indicators to that? Well, you have to look at the banks. The banks are lending to everyone, and you're looking at that BDD charge. When I started in the industry in 91, we were in recession, and bad and doubtful debt charge was close to 100 points. My old boss, Kerry Packer, bought Westpac, and he would have made a lot of money if he just held on to that, but he sold it out, made over $350 million on the position, because he thought Westpac was going to go under in the 91 recession. Then through the GFC, BDDs went up to 125 basis points. Then in COVID, they went up to 70 basis points. BDDs are now south of 25 basis points. So what I'm watching now are the lead indicators on the bad and doubtful debt charges in regards to who the banks are lending to see whether a cohort is starting to feel the pressure. Now, as I indicated earlier, property developers are feeling the pressure, but that's not moving the needle for the BDDs. So at this stage, the consumer is still very resilient. At this stage, the economy is still very resilient, and we haven't seen a turn. But I think you've got to wait for that now. And I think if you go very aggressively short the consumer now, you're going to be in trouble because you've got to get your timing right. And I think at this stage, I think you need to wait to see how it plays out.
Last question: if an investor's sitting on cash today,
congratulations.
Actually, yeah, true.
Well, you made
it through.
Congratulations. The market is down from yesterday 1.5%. So, and I think the market's probably down another 50 basis points today. So you're down 2%. I find it extraordinary. Everyone's getting very nervous. And when you take a step back, the market's really only down 1.5%. What's everyone going to say if the market, heaven forbid, goes down 10 to 15? So we're not in that position. If you're sitting on cash at the moment, I will be looking to deploy some of that cash in the companies that you want to invest in. And when I look back, the two areas I want to invest in are structural growth companies independent of a cycle of interest rates and sticker inflation. And they're companies like Life360, like REA, like car sales, but not at these multiples. The second area is defensive growth companies that are devoid of any tariff impact, that are devoid of any cycle, consumer cycle, and that's healthcare. So I'll be looking at Cochlear has come back very aggressively. We're looking very closely at CSL for the first time in 3 years as well. So there are this volatility gives you opportunity to invest your cash, but you need to be patient in regards to when you do invest your cash at the right multiple.
Yep.
And that's going to be the key. I think everyone's looking at Buffett. Buffett's portfolio is 32% cash. He went aggressively overweight cash in the last 2-3 years. He was 20% cash going into the GFC, but a lot of people forget to realize that he raised that in 2005. And he was 3 years early. We've had this conversation of banks. We've been underweight and short banks for the last 17 months. We were actually 17 months too early. So I think if you've got a lot of cash on the sideline, I think you should be doing the work now in regards to the companies that you want to be in. And the attributes have to be free cash flow, balance sheet, and strong earnings. And then overlay that with a valuation. And then you start to move when that valuation comes into play.
So we've covered a lot today. We've covered what happened in this most volatile reporting season. We've talked about the macro tensions and the impacts of what's happening with Trump and the short and long term bearings of what may or may not impact Australian equities. And then we also talked about the state of the Australian consumer. Now, Gian's talked about a number of stocks. As always, please listen to the disclaimer at the end of this podcast, as we clearly are not taking any responsibility for anyone that goes out and starts, utilizing their congratulatory cash reserves post this cost of living crisis. But Gian, thanks very much for coming on the show, and speak to you next time.
Pleasure. Thank you very much, Jonathan.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.